February 2026, COMEX registered inventory, 103 million ounces. Open interest, 429 million. Everyone sees the math. Everyone knows it doesn't work. But here's what they're missing. While traders were watching vault flows and margin hikes, tech giants were doing something they've never done before, bypassing COMEX entirely. Samsung signed a deal, $7 million for exclusive rights to 100% of a Mexican mine's output. For 2 years, the metal will never reach an exchange. It will never appear in a vault. It will never show up in spot markets. It's gone before it's even mined. And Samsung is just the first. This is the silent ledger. And what I'm about to show you is not a silver story. This is a paradigm shift. Tech giants are locking up physical supply directly at the source. And by the time COMEX realizes what's happening, there won't be any metal left to deliver. Here's what nobody's talking about. This is not market-based procurement. Market-based procurement means you go to COMEX, you buy a contract, you take delivery if you want, you roll forward if you don't. That's how it's worked for 50 years. Samsung didn't do that. Samsung went to a Canadian mining company, gave them $7 million up front, locked up 100% of mine output before the first ounce is even pulled from the ground. And here's the part that should make every COMEX bull sick. That metal will never be available to anyone else, not to speculators, not to other industrial buyers, not to exchanges. Samsung owns it, exclusively, for 2 years. Let me explain what La Parrilla actually is. It's a past-producing silver mine complex in Durango, Mexico. It's been idle since 2019, 2,000 metric tons per day milling capacity, 3 underground mines. Silverstore Mining, the Canadian company that owns it, needed capital to restart operations. Mill rehabilitation, underground development, working capital. Samsung C&T, that's Samsung's commodities trading arm, provided the money, $7 million, 18-month facility. But the price wasn't interest. The price was metal. 100% of lead silver concentrate and zinc concentrate produced for 2 years. Production is expected to restart in phases through 2026. Based on historical output and current plans, La Parrilla could produce 3 to 5 million ounces of silver annually. That's 6 to 10 million ounces over 2 years. All of it going to Samsung. Now let me put that in context. COMEX registered inventory as of early February 2026 is around 103 million ounces. Samsung just locked 6 to 10 million ounces that will never reach COMEX. That's 6 to 10% of COMEX registered inventory. Except it's worse than that, because this metal was never in the inventory to begin with. Markets are pricing silver based on the assumption that mine output flows to exchanges. Samsung just proved that assumption is wrong. Now let me show you why Samsung did this. Samsung is developing solid-state batteries, not lithium-ion. Solid electrolyte, safer, higher energy density, faster charging, and they require silver. Samsung's design uses a silver-carbon composite layer in the anode, 5 micrometers thick. Critical. Stanford researchers just published findings in January 2026. A nanoscale silver coating makes solid electrolytes 5 times more resistant to cracking. 5 times. Without silver, solid-state batteries fail from ceramic fractures during charging. With silver, they work. It's not optional. It's essential. Here's the number. Each Samsung solid-state battery cell contains about 5 grams of silver. A 100 kilowatt-hour EV battery pack uses 1 kilogram, 32 troy ounces per car. Current lithium-ion batteries? Maybe tens of grams. Samsung's design uses 10 to 20 times more. Global EV production, late 2020s, 20 to 30 million units annually. If Samsung captures 20%, that's 3.2 million cars. At 32 ounces each, 102 million ounces of annual demand. That's more than the entire COMEX registered inventory, every year. At 50% adoption, 256 million ounces. At 80%, nearly all global mine production, just for batteries. But wait, this is not just Samsung. Tesla is watching. Apple is watching. Tesla has been pursuing vertical integration for years. They build their own batteries. In November 2025, Tesla's procurement team started sourcing cathode materials, anode materials, copper foil directly from Korean suppliers. In January 2026, they put 4680 cells back in Model Y vehicles. Why? Supply chain diversification, tariff hedges. If Chinese suppliers get cut off, they need domestic control. And domestic control means locking raw materials at the source. Which brings us to the impossible triangle. Silver supply is constrained. 75 to 80% comes as byproduct from copper and zinc mining. Higher silver prices can't quickly increase supply if base metal economics don't justify operations. Primary silver mines are only 25% of output, and they take years to develop. Meanwhile, demand is inelastic. Industrial buyers must have silver regardless of price. Something has to break. And here's what's breaking. The procurement model. For decades, industrial buyers sourced silver through exchanges and spot markets, COMEX, LBMA, transparent pricing, liquid markets, easy access. That model assumed there would always be metal available at the quoted price. Samsung just proved that assumption is wrong. When you're a tech giant betting billions on a technology that requires a specific material, you don't trust the spot market, you don't trust COMEX vault flows, you go directly to the mine and you lock it up. Let me show you what this looks like in practice. Samsung gave Silverstorm Mining $7 million. That's the prepayment. It's essentially a loan. Silverstorm uses that money to restart the mine, rehabilitate the mill, develop underground operations, hire workers. In return, Samsung gets 100% of concentrate output for 2 years. The financing is secured through corporate guarantee, share pledge, and first-ranking security on Parrilla's assets. Repayments start in May 2026 and are made through deductions from concentrate sales. Samsung is buying the metal at a negotiated price, probably linked to spot, but with a floor and ceiling. They're not exposed to spot market volatility. They're not competing with speculators for delivery. They have guaranteed supply. Now imagine Tesla does the same thing. Apple does the same thing. BMW, Ford, General Motors. Every automaker with an EV program, every tech company building AI infrastructure that needs silver for semiconductors and cooling systems, every solar panel manufacturer. They all start signing prepayment deals with mines, locking up output before it's produced. What happens to COMEX? What happens to spot markets? The metal stops flowing to exchanges. Registered inventory doesn't replenish. Open interest keeps growing because traders don't know the physical supply is already allocated. And one day, probably soon, someone stands for delivery and COMEX says, we don't have it. It's already spoken for. By Samsung, by Tesla, by companies that bypassed the exchange entirely. Here's the timeline that should scare you. October 2025, Samsung signs the deal. Nobody notices. It's a small Canadian mining company, $7 million. Barely a headline. January 2026, drilling starts. 6,000 meters of underground drilling to prepare for restart. Still, nobody's paying attention. Q2 2026, production expected to begin. That's April through June, 3 to 4 months from now. Metal starts flowing, all of it to Samsung, none of it to COMEX. And by the time markets realize what's happening, Samsung will have secured millions of ounces that were never available to anyone else. But here's what makes this existential for paper silver. A significant portion of what's reported as registered silver on COMEX is either non-eligible or already encumbered. It's not truly available for delivery. The pool of actually deliverable, fully eligible silver is much smaller than headline figures suggest. When delivery notices arrive, custodians have to distinguish between inventory they control outright and inventory they control subject to someone else as rights. Nobody knows the real number, but it's less than 103 million ounces, possibly a lot less. And now you have industrial demand that's not going through the exchange. It's going around it. Direct to mines. If Parrilla produces 5 million ounces over 2 years for Samsung, that's 5 million ounces that don't replenish COMEX vaults. If 10 more mines sign similar deals with 10 more tech companies, that's 50 million ounces per year that disappear from the exchange-based system. COMEX pricing assumes mine output flows to market. What happens when it doesn't? Let me paint you 3 scenarios. Scenario 1, the slow bleed. Tech companies keep signing direct deals. COMEX inventory drops from 100 million to 80 to 60. Premiums widen. Paper to physical ratio hits 8 to 1, 10 to 1. The futures market loses credibility. Physical trades at multiples of paper. Scenario 2, the supply shock. Samsung's batteries hit mass production fast. Demand jumps 200 million ounces in 24 months. Everyone panics. Solar companies, semiconductor fabs, all rush to lock mines. There aren't enough. Prices spike to 200, 300, 500. Governments intervene. Export controls spread. Rationing. Scenario 3, the arms race. Tesla announces a mining deal. Apple follows. Within 6 months, every tech giant locks supply. Retail investors shut out completely. Spot markets freeze. COMEX settles cash only. The exchange collapses. Anyone holding paper finds out it was never real. Now let me show you why this is accelerating. The Stanford research on silver coatings for solid-state batteries was published January 16th, 2026, 2 weeks ago. The findings show silver makes electrolytes 5 times more crack-resistant. Now that's not incremental, that's game-changing. Samsung has been working on this since at least 2020 when they published their initial research on silver carbon anodes in Nature Energy. But the Stanford work confirms silver is essential, not optional. Every battery manufacturer studying solid-state technology now knows they need silver, and they know mine supply is limited. So what do you do if you're Tesla? You've been building vertical integration for years. You make your own batteries. You're sourcing materials directly. You see Samsung lock up a Mexican mine. You see the Stanford research proving silver is critical. You run the numbers. If solid state wins, and it probably will because the performance advantages are too large to ignore, you need tens of millions of ounces per year. You can't buy that on COMEX. The market isn't deep enough. The only rational move is to go directly to miners. Sign prepayment deals. Lock up output before your competitors do. And here's the part that makes this a crisis. There aren't that many primary silver mines. Most silver is byproduct. You can't just call up a copper mine and ask them to produce more silver. It comes out based on the copper economics. Primary silver mines that could sign these deals, we're talking maybe a few dozen globally that are large enough to matter. Samsung took one. If 10 more tech companies take 10 more mines, that's a significant portion of non-byproduct supply locked up. The market doesn't realize this yet because the deals happen quietly. Samsung C&T Hong Kong Limited signs an agreement with Silverstorm Mining. It's a Business Wire press release. Traders scrolling Bloomberg don't even see it, but the metal is gone. 2 years of production, allocated before it's mined. And the procurement managers at Tesla and Apple and every other tech company definitely saw it. They're not watching COMEX futures, they're watching supply chains. And they just saw a competitor secure exclusive rights to millions of ounces. The arms race has started. We just don't know it yet because most of these deals aren't public. Samsung's was only public because Silverstorm is a publicly traded mining company that has to disclose material agreements. How many private deals have already been signed that we'll never hear about? Let me give you one more data point that should keep you awake at night. Throughout 2025, industrial demand from AI hardware and renewable energy infrastructure consumed an estimated 60% of total global silver production. That's before Samsung's solid-state batteries go into mass production, before Tesla scales their vertical integration into silver sourcing, before every solar panel manufacturer locks up supply ahead of the next wave of installations. 60% is already gone. Industrial, inelastic, not price sensitive. The remaining 40% services investment demand, jewelry, and whatever's left flows to exchanges as available inventory. If Samsung's batteries add another 20 to 30% of production to industrial demand, you're at 80 to 90% of mine output consumed by industry. That leaves 10 to 20% for everything else. COMEX, LBMA, retail investors, jewelry, silverware. Good luck sourcing metal in that environment. Now overlay the fact that silver has been in a supply deficit for 5 consecutive years. Global demand has exceeded mine supply every year since 2021. The deficit is covered by above-ground stocks, vaults, recycling. Drawdowns from inventories that took decades to build. Those inventories are not infinite. And if tech companies start locking up future mine output, the deficit gets worse, not better. Here's what makes this different from gold. Gold is 75% investment and jewelry. Demand is price elastic. If gold goes from $3,000 to $6,000, people buy less jewelry. Investment demand might increase, but industrial demand is minimal. Gold doesn't go into batteries or solar panels at scale. Silver is the opposite, 60% industrial. If silver goes from $75 to $150, solar panel manufacturers don't stop building panels. Semiconductor fabs don't stop making chips. Electric vehicle factories don't stop making cars. They pay the higher price because they have to. The inelasticity creates a reflexive loop. Rising prices don't reduce demand. They increase urgency to lock supply, which drives more prepayment deals, which removes more metal from exchanges, which drives prices higher. Let me tell you what this means for COMEX. Right now, March 2026, silver open interest represents around 425 to 450 million ounces of exposure. Registered inventory is 103 million ounces. If even 30% of contracts stand for delivery, COMEX needs 130 million ounces. They don't have it. They'll source from eligible inventory, from London, from wherever they can. But here's the problem. If Samsung controls Parrilla's output, if Tesla signs similar deals, if Apple locks up mines, where does COMEX source emergency metal? The supply that used to be available, the swing production that could flow to exchanges when premiums spiked, is now contractually obligated to tech companies. COMEX can raise margins. They can halt trading. They can force cash settlements. But they cannot create silver that doesn't exist. And for the first time in modern history, industrial buyers are making sure the silver that does exist never reaches the exchange. This is not a speculation. This is not a prediction. This is math. Samsung signed the deal. The contract is public, 100% of output for 2 years. That metal is not available to COMEX. If 5 more deals like this get signed in the next 6 months, and they will, exchanges face a structural supply problem they cannot solve with financial engineering. So what happens next? Here's my best guess based on the pattern. Q2 2026, Parrilla restarts production. Metal starts flowing to Samsung. Markets don't notice because it was never in COMEX to begin with. Q3 2026, another tech company announces a mining deal. maybe Tesla, maybe Apple. The market starts to pay attention. Silver spikes. COMEX struggles with delivery in a major month. Premiums for physical widen. Q4 2026 into 2027, more mining deals announced. Vertical integration becomes the dominant strategy for anyone who needs silver at industrial scale. Exchanges lose relevance. Price discovery fractures into multiple tiers. Paper silver. Exchange deliverable physical. Privately contracted supply. And by 2027 or 2028, the paper silver market is functionally dead. Trades still happen. Contracts still settle. But nobody believes the price represents physical reality anymore. And here's what happens to price in that scenario. If solid-state battery adoption reaches even moderate levels, silver demand could exceed total mine supply within a few years. Samsung's design alone at 50% EV adoption consumes more than half of global annual production. Add in solar, semiconductors, AI infrastructure, medical devices, existing industrial uses. You're in a deficit so large that above-ground stocks deplete in years, not decades. At that point, price has to rise enough to either ration demand or stimulate new supply. But new supply takes 7 to 10 years to develop a mine. And most silver is byproduct, so you can't just stimulate silver production. You have to wait for copper or zinc economics to justify new mines, which means price has to ration demand. But 60% of demand is industrial and inelastic, so price might have to go very, very high before consumption actually drops. How high? I don't know. Nobody knows. But if you're a procurement manager at a solar company and silver hits $200 per ounce, you don't stop building panels. You raise panel prices or accept lower margins. You don't have a choice. The factory needs silver. There is no substitute. So you pay. And the next month, silver is $250, then $300, then $400. It keeps going until someone, somewhere, stops consuming, or until new mines come online, which takes a decade. This is not a short-term trade. This is a structural realignment. For 50 years, companies trusted exchanges. That model worked when supply exceeded demand and mine output flowed freely. It doesn't work when supply is in deficit and tech giants bypass exchanges entirely. The Samsung deal is the canary. $7 million. For a mine nobody heard of. It seems small, but it's the first public example. What's coming is the end of COMEX as a reliable industrial source. I'm not saying silver hits 1,000 tomorrow. I'm not saying COMEX defaults next week. What I am saying is this. Samsung locked 100% of a mine. That contract is real. If that model spreads, the exchange market faces a crisis it cannot solve. Tech giants with billions will outcompete speculators every time. Risks exist. Solid state could fail. Other chemistries could win. Governments could intervene. New mines could come online faster. But this is the third year industrial demand exceeded mine supply. The deficit is growing. And now tech companies secure supply outside exchanges. That's structural. Once vertical integration dominates, you don't go back. Samsung locked 6 to 10 million ounces for 2 years. 6 to 10% of COMEX inventory. Gone before it was mined. If 10 companies lock 10 mines, exchanges become a sideshow. The real metal flows mine to factory, bypassing COMEX entirely. This is the silent ledger. The procurement model is changing. Tech giants lock physical at the source. By the time COMEX realizes there won't be metal left to deliver, now you know what's coming.